Group 46, The Impact of Economic Setbacks on the Global Economy. After reading and analyzing the article we were given, Big Risks, Big Opportunities Demand Big Economic Policy Breakthroughs by William A. McDonald, we chose 4 economic issues the author discussed: the Great Recession, Chinese stock market crash, brain drain, and climate change. In this presentation, we will demonstrate the impact each of these setbacks has on the global economy.
The Great Recession was a financial crisis triggered by a stock market crash in the US and slowly spread on a global scale from 2007 to 2009. Some effects of the Great Recession were shown through decreases in aggregate expenditure and spikes in the unemployment rate during the 3 years of recession. The first economic area that the Great Recession impacted was aggregate expenditure, resulting in shifts to the aggregate expenditure curves on a diagram. Due to the recession, consumption dropped due to reduced customer confidence, which increased household savings and decreased major investments from private sector firms. This caused consumption and investments in the aggregate demand equation to drop, resulting in a leftward shift in the aggregate demand curve. Because aggregate demand shifts left, it caused the equilibrium price level to decrease and the equilibrium real GDP to decrease as well. Aside from GDP and prices, the recession caused a spike in the unemployment rates in Canada. This would be an example of cyclical unemployment. The definition states that workers experience unemployment during a recession, in which this recession matches the criteria exactly, as thousands of Canadian workers were laid off due to financial collapses in many workplaces.
Chinese stock market crash. It cases a half of Shanghai Stock Exchange's shares lost in a month. Major stock happened around July 8 to 9, 2015. Bubble effect to global financial markets such as Dow Jones Industrial Average and devalued shares of multinational corporations. The bear market, it means that stock prices are going low and it can have negative effect on sentiment. Investigators rush to sell stocks to prevent losses on their investments. Typically, those losses lead to a pullback in consumer spending, particularly if there's also the fear of recession. There is definition of recession, and for the formula of GDP, you guys can see the stock market crash will affect the investment side since it will decrease investigator trust to the capital market. Meanwhile, as the effect of crash to the real sector, it may affect the consumption side too. Therefore, the real GDP will shift to the left. A stock market crash led to leftward side of aggregate demand. The equilibrium level of output and the price will fall. Since the quantity of output is less than the natural rate of output, the unemployment rate will rise above the natural rate of unemployment.
Another topic discussed by McDonald in the article is brain drain, the emigration of highly educated individuals due to better opportunities in other countries. Brain drain has many effects on the economy, such as loss of tax revenue, loss of education, and a shortage of essential workers. The loss of tax revenue affects a country's loanable funds. As taxes decrease, so does public savings, causing a leftward shift in the supply curve. As a result, the interest rate increases and the quantity of loanable funds decreases. This loss also results in an economic deficit, as taxes will begin to be less than the sum of the government spendings and transfers. Brain drain also causes a shortage of essential workers, as many residents are relocating for better opportunities. This affects the country's production possibility frontier. Less workers means less capital, resulting in an inward shift of the PPF curve. Brain drain causes a decrease in education, which causes a loss of essential workers, resulting in quantity of capital goods reducing, thus a decrease in tax revenue. This is an endless cycle that countries must break in order to beat brain drain.
Very large toll on the economy. It has cost North America billions of dollars in repairs as well as in funding for healthcare due to temperature-related illnesses. Both of these has caused the government to have to increase in spending, which would come with an increase in taxes. An increase in taxes would cause a decrease in consumption spending, investment, and net exports, which are all components of aggregate expenditure and would therefore cause aggregate demand to also decrease. Climate volatility may also force companies to deal with uncertainty in the price of resources of production, which may cause companies to decrease supply. This is because it could potentially cost companies more to produce, which would incentivize them to produce less. Climate change also causes a decrease in many products, particularly in the agriculture sector. This would cause a decrease in the supply for products in this market, which would cause the supply curve to shift to the left. This would be followed by a deficit in the supply, which would need to be solved by a decrease in demand. In conclusion, the global economy is affected in many different ways by the Great Recession, the Chinese stock market crash, brain drain, and lastly, climate change.